another question on missing variance, but this time on the sales variance and with respect to two products. The products are R and S. So, dear friend, this question is presented in the chart form. You are provided with standard sales quantity, actual sales quantity of product R and S. There are certain missing variances indicated by the question mark. Standard price per unit, actual price per unit of R and S is given. Your sales price variance, the sales volume variance, sales value variance, some informations are given and some informations are given as a question mark. What is provided is that sales mix variance for both the product together was rupees 450 favorable. So, please find out the missing variance. This question is, if you remember, a question you are applying for two products, the total variances relating to sales, and you have to take up each product separately. Therefore, you have to be very cautious because you have limited time in the exam hall condition, and as you are doing for two products together, you have to do all the steps methodically. So, let us start working with me, friends. You start with making a statement showing standard and actual data. You might notice some of the item given in the question has a question mark. So, product are R and S, standard and budgeted quantity, the quantity, the price per unit and the amount. Likewise, you have actual data, quantity, price per unit and the amount. So, some of the information might not be there. So, for time being we will keep it not marked, it will be open, and when we will be solving the relevant thing, we will be putting the solution at that particular place. So, dear friend, let us start. You have a question mark here, you have 400. So, I am noting down from the question paper. So, a total column is also there. So, this is the statement which comes out when you put the figure. The idea of this statement is to get the standard and actual cost data. Now, we start with product R. So, sales price variance, this is actual quantity into actual price. So, 500 units is the quantity The actual price in the question is this 15 rupees and budgeted price is 12 rupees. So, if you solve, this becomes 1500 favorable, right. Then you come to sales volume variance. The formula you already know, budgeted price multiplied to actual quantity minus budgeted quantity. 1200 favorable is equal to rupees 12, actual quantity is 500 units, budgeted quantity is to be found. So, budgeted quantity, if we solve, what we get? The budgeted quantity on solution comes 400 units. So, friend, please check whether the result is correct. So, if you put 400 here, 500 minus 400 is 100, 100 multiplied with 12, so 1200 favorable. So, always keep on checking this data, because if you get wrong result, you apply to the next equation, the next result is wrong, and that is the way where you are likely to lose mark. Therefore, my sincere advice is to check by putting the solution which you have got in the shape of x into the equation and find out whether the variances are matching. After getting this, you get your sales value variance. So, sales value variance is sales price variance plus sales volume variance. So, this is, you have already got 1500 favorable plus 1200 favorable. So, this becomes 2700 favorable. So, now you have got data. So, please put 400 here, this becomes 800, right. So, 400 into 12, now this is 4800. So, 4800 and 6000, this becomes 10,800, right. So, what we are doing? The values what we have got, we have put it upstairs and we have worked out the solution. So, if you see, for R, we have all information now. We do not have information about the other product S. So, let us start working on product S. Again we will get for S and we will complete this blank mark. That is the next goal. So, let us do that together. So, now we are going to have the certain figures missing. So, sales mix variance. Before I proceed, why don't we do one more thing? We change this with some symbol. Let's write T, because then you can create something mathematical, right. Why I have done this? Because I have mix variance for both the product together. So, I am going to form an equation. So, let us do for product S with me. Sales mix variance, this is equal to total actual quantity into average budgeted price per unit of actual mix minus average price per unit of budgeted mix. So, the question says this is 450 favorable. Now, I am going to create the equation. So, the equation is this value is separate and this value is in bracket. So, if you can see, this formula is total actual quantity, right, and this is multiplied to average budgeted price per unit of actual mix minus average price per unit of budgeted mix. So, this is outside the bracket. What is important to see? That actual quantity is outside the bracket and average budgeted price per unit of actual mix and average price of budgeted mix is outside. Sorry, average budgeted price per unit is within the bracket. So, basically if I have to refine this formula, I can write it like actual quantity into average budgeted price per unit of actual mix. So, do not write it, just understand actual quantity is outside the bracket and other things are within the bracket, right. So, अंदर बाहर, बाहर में actual quantity है, अंदर में average budgeted price per unit of actual mix है और average price per unit of budgeted mix है. So, I am using Hindi to make you understand, firm up this thing, because on this basis the calculation is going to be solved. So, 500 units plus T, this part is there. I multiply this with 500 units into 12 plus T units. This I have done for R, this I am doing for S, into rupees 15, right, divided by 500 units plus T units, right, minus 10,800 divided by 800 units. So, this is the equation. Now, if you solve this equation, T will become how much? 800 units. So, please solve this equation yourself. The algebraic equation is 500 plus T, this is in terms of quantity, bracket is 500 units into 12, this is for R. For S, it is T units into rupees 15 divided by 500 units plus T. This is for average budgeted price per unit of actual mix minus average price per unit of budgeted mix. The budgeted mix is 10,800, right? The number of corresponding unit is 800. So, if you solve, T becomes 800 units. So, you have got the result. So, T is 800 units. So, please finish this. You write 800 here. So, 800 into 20, it is 16,000. 500 plus 800, this is 1300, and this becomes 23,500. So, this is now how this table is completed. So, friend, you have done the part of the solution. Now, I am going to do the calculation of the variances which is there in S. So I rub this board and solve for all the variances of S. So now we do the variance computation for S. So sales price variance is actual quantity into actual price minus budgeted price. So you have 800 units now, you have computed it. This is rupees 20 minus rupees 15. So if you solve it, this is 4000 favorable. So this is the sales price variance. Now sales volume variance. This is budgeted price into actual quantity minus budgeted quantity. So this is rupees 15, 800 units minus 400 units. So if you solve it, it is coming at rupees 6000 and it is favorable. The third is a combination, sales value variances. This is the sales price variance plus sales value variance. I am writing in short. So just add it, rupees 4000 favorable plus rupees 6000 favorable. This works out rupees 10,000 favorable. So friend, you have got the result, you have got the computation. Only keep one thing in the mind, that the treatment of cost variance and sales variance are just opposite. In cost, we say a variance is adverse when it is not controllable, more is being spent than decided, adverse. But in case of sales, we say it's adverse when you don't reach to the sales level. Therefore, the treatment has to be different. Now, suppose you are the examiner of this question, how you will mark it? You see, you have two products. Therefore, the allocation of marks becomes equally in R and S. 1 point is of the missing of the sales mix variance, that will have more weightage. Therefore, please do each part of the question properly. This is very, very important. Now, I am going to do one missing variance question on overhead.